All right, we are going to take a look at a fixed loan interest rate this time, and we're going to have some fun in this video. It's going to look a little bit different than the last couple of videos with respect to how the cash value functions when we take a loan against our policy. So we are going to look at a fixed loan interest rate of 6% in this particular example. This will be the same policy we've looked at in the last several videos. We've got the Mass Mutual 10-pay policy, which is designed with a 10/90 split minimum premium, cash rich right out of the gates and long term. Here's the thing though. If we elect their fixed loan interest rate, we have a direct recognition policy. Mass Mutual's fixed loan interest rate is 6%. If we start out with that rate, we're locked into that rate forever. With the exception of the first 90 days, you can elect to do what's called a policy reissue and change the design of the policy and then switch the rate to variable if you find out after the fact, I prefer variable instead of fixed, or vice versa. But that's additional information. So, direct recognition. When you hear that, what comes to mind? Well, if you're interested in borrowing directly against your policy, typically one thinks, if I have a direct recognition contract, it's bad, and the company will lower my dividend rate on borrowed funds. When you look at a company like Mass Mutual, their 2022 dividend interest rate is at 6%. That includes the guaranteed rate and the surplus. So now, if we're going to take the fixed loan interest rate in 2022, on paper, it appears to be a wash. Keep in mind I said on paper. We've hit on the difference between the dividend rate and the internal rate of return in the last several videos. That dividend rate does not result in a 6% growth rate. The IRR will fall somewhere between 4 to 4.5% when we look at the net performance, or internal rate of return is what IRR stands for. So we are going to look at the same thing we did in the last videos, meaning we're going to look at a policy funded at $100K per year for 10 years, $500,000 loan, repay it, pay interest only, no repayment at all. But when we look at the numbers, try and focus on the cash value, particularly in the example when we repay it. Remember, we always like to look at what the policy looks like if we just let it sit and grow, but then what does it look like if we borrow and repay? Because with a non-direct recognition policy, what would happen? Our values would be fully restored to exactly what they would have been as if we never touched it in the first place. Before we just jump into the numbers, let's take a look at the illustrations just to validate everything. So here we go. Let's start with the growth example here, because I want to highlight a column that we had not highlighted in the last several videos with the different variable loan interest rates. So here we go. Design of the policy. Where is my money going? Again, it can go toward the premium. Here's my base premium, represented by the base policy insurance. The $153,000 is the whole life death benefit that is purchased from the $10,000 base premium. And remember that this is a 10-pay product, which will function differently than a traditional whole life 100 product. Then we've got the term insurance rider, renewable term rider, which even though it is a renewable term rider with Mass Mutual, it is actually level for the first 10 years based on the current expenses. They reserve the right to increase it, but they typically don't. It remains level. And then everything else toward PUAs. AILR, additional life insurance rider. Additional information to provide awareness. If you're interested in a Mass Mutual policy and you've heard us state before that you can adjust payments one time per year, every year on your anniversary date without any underwriting at all. That is the case if you have a Mass Mutual policy and the LISR rider is attached, their life insurance supplement rider. You'll notice that it is not attached in this example. If you attach LISR to a Mass Mutual policy, they do not permit the fixed loan interest rate to be selected. So if we attach LISR, we can only illustrate the variable loan interest rate. And if you're a policyholder, your only option is the variable rate. If you want the fixed loan rate provision, you have to select a policy without LISR, which does impact the policy flexibility regarding how often you can adjust without any underwriting at all. If this had LISR, I could say I want to pay $100,000 in this year, then $50K. Let's say it's $50K through year 6 or year 7. Then I want to make a big catch-up payment and pay in $300K without any underwriting. You can do that kind of stuff. if you have that lister rider attached to the policy. So main point here, because I know this video is about policy loans, if we have the fixed loan interest rate attached, this is not available. So back to the policy here. Total cash value, we're paying in $100K per year. Year one, $100K goes in. You've got 89.5% right off the bat. When's your break-even point? $100K per year. By year four, I've paid in $400,000. I have $400,000. That's my break-even point. Now, this column here, annual dividend column, this does not represent a company's dividend rate, in this case 6%. This column actually does not include the guaranteed portion. So it only reflects the surplus portion of a life insurance policy, and we discussed that in other videos. I would check out how to read a detailed illustration of a life insurance policy on our channel for a full breakdown on that. But this dividend column only reflects the surplus. Here's what I want to hit on. As you look at this guy, year six, that dividend column represents $19,887. The year before, year five, it's $16,290. Keep those numbers in mind. $16,290 in year five, $19,887 in year six. Keep that in mind. Let's look at the same policy, but with a policy loan coming out in year five. It's really interesting here. Remember, this is with the fixed loan interest rate with MassMutual and their direct recognition treatment. Here's your payments. Year four, same break-even point, exact same policy. We're going to pull up the Excel spreadsheet with a side-by-side shortly, but identical policy. Dividend column, what was it year five in the example where we never took loans? $16,290. What was it the following year? $19,887. What do we have here? $25,137. Where did that come from? Here's the reason why. So this illustration is the same 10-pay policy, but we're taking out a policy loan. Same loan we've looked at in the last several videos, the $500,000 loan. What's the impact? Well, the cash value determines how much we can borrow. And the death benefit will take a reduction. But what happens with a direct recognition company or direct recognition policy, the company is still going to apply dividends to any money still in equity, call it non-borrowed cash value, and also borrowed cash value. What MassMutual does here is apply a dividend interest rate of 6%, which is their 2022 dividend rate, to whatever is in cash value. And then they apply a dividend rate that right now is much higher than 6% to the borrowed funds when we look at our loan balance. Now, they do not disclose that rate when you look at the language with respect to how their direct recognition treatment works. It has to do with their general account and what they have to earn as a company. It can be a bit confusing when you read through it, but my point is they do not disclose the crediting rate like some companies do. Guardian does disclose what the dividend rate is on borrowed funds. What I'll add about MassMutual, their direct recognition treatment is and has been favorable in a low interest rate environment. If we rewind the clock about 6 or 7 years to when they had a 7.1% dividend interest rate, what was interesting about that period of time is whenever you elected the fixed loan interest rate and looked at policy loans, they would actually reduce the dividend rate on borrowed funds. So the point here is that the company does have a degree of control. Now also it's MassMutual, fixed loan interest rate of 6%. Some people are attracted to that because I can lock in a fixed loan interest rate forever. And then if I want a lower loan interest rate, I can leverage a cash value collateral loan, going to a third-party lender. That's a variable loan rate that allows me to take advantage of a fixed rate or lock that in and still get a variable loan rate with, again, a third-party lender through a collateral assignment. But my point here is we see that higher dividend column here because we're receiving a higher dividend rate on the borrowed cash value. Interesting stuff, isn't it? Let's look at a side-by-side and start to simplify things here a bit. So, what do we got here? The loan and repayment example. This will be the fun one because we get to see what the cash value death benefit looks like after we pay everything back. So here's our growth scenario. What I always like to look at, if I'm the individual taking out a policy, so if you're looking at a policy before you look at loans, buyer's remorse typically does not occur with policy loans, typically occurs when we found out we could have had more money in cash value and death benefit. That has to do with the design of the policy. 100K going in, 89.5 right off the bat. Year 2, 100K goes in, grows from 89.5 to 186. So I got less than the 100K I paid into the policy back in cash value. I got about 97K there. Next year I pay in 100K, grows from 186 to 290, meaning I got my 100K back, plus another $4,000. So now it's starting to pick up the pace. Positive, by year 4, I recapture all of my money, and then starts to compound over time, getting better and better. When we look at the loan scenario, here's your policy loan, $500,000. What's the impact of that loan? Again, the cash value is the gauge that determines how much you can access. If I have $100,000 in cash value, I won't be able to take out a $500,000 policy loan. So my cash value is 111. In the example where I did not touch it in year 6, it was 636. What's the difference there? Just about $30,000, or I should say the $500,000 loan plus almost another $30,000, not quite. The reason why it's not just a clean 500K is I have the loan interest that is being accounted for as well. Notice I begin paying it the next year in this particular example. So here, the loan interest comes due, I pay the loan interest. What we did here was pay the loan interest out of pocket through the 10th year. We didn't repay anything in policy loans just because sometimes people express, if I'm still funding the policy, I want to make sure I cover the loan interest, but funding the policy up to the maximum level and repaying my loans at the same time, I'm not comfortable with that, or I don't have the cash flow to do that right now. Can I just pay the loan interest expense and then cover the loan balance later? The answer is yes. You can attack it however you want, really, when you look at it. But in this model, we just assumed paying interest only, and then at year 11, after we're no longer funding the policy, you wanted to fund it up until age 50, now he begins to repay the loans. And what's interesting about this, there's so many different ways to do it. You can have a lot of fun. What some people like to see is, hey, what's it look like if after, call it 6 years, I stop funding it at 100K, I just fund it at 50K, and I take the other 50,000 I was paying and apply it toward loans. We've got a case study on that. It has to do with where your money goes between premium, PUAs, or loan payments. You can watch that up here. But that is a fun video that goes through different examples of that. But back to this example. When we repay it, so first off, the $30,000. $30,000, $500 comes out to what? 6%. That is fixed. It'll never increase. When we repay it, so we didn't include the dividend columns on these spreadsheets, but we don't really need them. If we go back to the detailed illustrations, here's what you'll notice. Year 15, what do you notice here? If I just parked money, let it sit and grow, my cash value is $1,507,000. My death benefit, 2.55. In the example when I borrowed and then repaid, if everything stays exactly like it is right now, which will not happen, it will change over time, but if everything stays the same, what do I notice? 1,557. So I got another $50,000 in earnings as a result of a higher dividend applied to the loan balance. Now what we have to account for, if we're comparing this to a variable loan interest rate scenario, is that I'm paying more loan interest to the insurance company. But it is a good option to be aware of. What I have found is some people appreciate this when they hear direct recognition always results in dividends being lowered. Not the case. Here we see it raised a bit. So let's look at the other examples quickly here so we can see the difference. Let's see what it looks like if we don't repay anything, because we do not have to pay loans. Same thing with the $500,000 loan. This is the loan and no repayment. There's your cash value and death benefit, exactly the same in year 6, because we didn't make any repayments in the repayment scenario either. But what do we notice? $530,000. That's my loan balance at the end of the next year. If I do not pay the loan interest, what happens is the policy will loan against itself to cover that loan interest. So then my loan balance the next year is $530,000. A fixed loan interest rate of 6% will be applied on that, which is 31.8. That's why I see the balance compound over time. Now, what do we notice over here? I'm still funding it at $100K per year through the 10th year. So it's still growing. I'm outpacing the loan interest. What about afterwards? I'll still see positive appreciation here. To simplify, you paid in $1 million, you loaned $500,000, so still $500,000 of equity that you never touched, and you're still earning dividends on everything. So as we take a look at this, time passes. Let's go down to age 85. There we go. Million in, technically over here, $500,000 in. So I pulled 500K, cash value about 2.8, death benefit 3.76 approximately. Those are the net values, net of the loan balance. So if I die at 85, death benefit is the 3.76 being paid out. If I want to access more cash value, the 2.79 is the amount that I have access to, versus the amount, if I don't touch it, 6.2 and almost $7 million. So we do see a difference there if we don't touch it, assuming the dividend stays at 6% forever, which will not happen with any company for that matter. And then we've got the interest-only example, which is pretty straightforward. I take the $500,000 loan out, there's my balance. Each year the interest comes due, I elect to pay it. And the nice thing about a fixed loan interest rate is it's fixed. Very predictable. I know exactly what it's going to be. I don't have to think about it. And if interest rates go up, I'm locked into that 6% rate forever. Going all the way down, age 85. There's my values if I don't touch it. Just about $500,000 less. What you could do here, if I came into a windfall at 85, or any age for that matter, and elect to pay off the $500,000 loan, what would you notice? The values would be higher than what we see over here. They're actually higher right now, and the reason why is because I am paying the loan interest each year, and I'm receiving the higher dividend on the $500,000 loan balance. So I've got to keep that in mind. But if I do elect to pay that back, $500,000 loan, think of it this way, you'll see 500K added to these guys, primarily the cash value. Death benefit will increase by a little bit more, but we're getting close to age 100. And why that's important is what happens at age 100? Cash value and death benefit become equal. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. Reach out if you have any questions at all, if you'd like to see some custom samples or some loan models. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.